Let's look at some example journal entries for notes receivables. So we have 5 transactions here for Vance Company that we need to prepare the journal entries for. So let's look at this first one. On March 1st, we loaned $100,000 to Sharp Company on a 3-month 8% note, meaning we are giving Sharp Company $100,000. They're supposed to pay us back within 3 months, and there will be 8% interest. But here, just on March 1st, how do we record that? Well, we want to debit notes receivable to show that notes receivable is increasing. And we want to credit our cash, showing that we are giving $100,000 to Sharp Company. Now on May 1st, we loaned $50,000 to Harper Company on a 9-month 9% note. So the framework of the entry is going to be similar to what we just did back on March 1st. Here, we debit our notes receivable for $50,000, since we're only loaning $50,000, and we credit our cash for that same amount. Now, June 1st rolls around, and Sharp Company dishonored its note, but Vance Company, we are Vance Company, we expect to collect this amount in the future. So when they dishonor their note, that's just saying that they didn't pay it back when they were supposed to, right? So what we do is we turn that notes receivable into an accounts receivable. So we want to debit accounts receivable here. So we'll credit our notes receivable for $100,000, because that's the amount that we loaned to Sharp Company. But then we also want to record the interest that was built up over the past 3 months. So we need to calculate our interest revenue here. To do that, we take our principal times the interest rate times time. So your principal, $100,000. Your interest rate is 8%. And remember, that's an annual interest rate. It doesn't matter that this is just a 3-month note. Then we multiply it by the amount of months over 12 that have passed, right? So there's been 3 months that have gone by, so we multiply it by 3 over 12. So we find that our interest revenue is this $2,000. So our accounts receivable, that will be debited for $102,000. So we'll have those journal entries now up in the upper right corner as we finish the last 2 entries. So on December 31st, we need to show the interest on the Harper Company note. So Harper Company, that's the note from back on May 1st. So we loaned $50,000 to Harper Company on a 9-month 9% note. We need to use that information to now figure out the interest here on December 31st. So again, it's your principal times rate times time. Our principal was $50,000. Our interest rate was 9% or 0.09. And then we multiply it by 8 over 12. And how did we get that 8? Well, we counted the number of months from May 1st through the end of December. So that's 8 months that have passed there. So when you multiply that out, you find that your interest is $3,000. So we will debit interest receivable, because we will be getting this interest later on. So we debit interest receivable for $3,000, and we credit interest revenue for $3,000. Then February 1st rolls around, and we collect principal and interest from Harper Company. So what are we collecting? We're collecting cash, right? So we'll debit our cash. Then we have a few accounts that we need to credit. We need to credit notes receivable for $50,000. That's the principal amount that we are collecting, right? So we want to show that they don't owe us that money anymore. So we credit our notes receivable. And then interest. Interest is going to be broken up into 2 different accounts here in this entry. First, we had our interest receivable. we had that $3,000 of interest that we had already recorded back in December. And then we also have interest revenue. So we need to figure out now this interest revenue for just the month of January, because we had already figured it out for the first 8 months, but we had not recorded any interest yet for January. So we take 50,000 times 0.09 times 1 over 12, since it's just for 1 month, and we find that our interest revenue is $375. So on February 1st, we're collecting principal and interest from Harper Company. So we add up our principal amount of $50,000 plus our interest amounts, and we see that we will receive $53,375 in cash.